Let's get started here. I'd like to tell you the story of the time that I saved Goldman Sachs from bankruptcy. The year was 2007. Altos Research was barely a year old, and I was at a conference hosted by Inman News, Brad Inman. And on the stage were bankers, traders from Goldman Sachs, Morgan Stanley, and Lehman Brothers, and they were talking about trading in the mortgage derivatives market. In 2007, this was a big market, as you may remember. And at the time, Altos Research was very new. But what we started to realize was the data that we had, the approach that we took to analyzing the real estate market, by watching the active market and the pricing and the changes in the pricing and the inventory levels and the changes in those, we had more information months ahead of the headlines that everybody else knew. And I said this after the panel, I went up and introduced myself to the speaker from Goldman Sachs and the speaker from Lehman. And when I said to the Lehman Brothers guy, I said, hey, we have this great data. We can see what's happening with what the headlines are going to say in 30, 60, 90, 120 days. The Lehman Brothers analyst traders said, Mike, we got more data than you could ever know. He wouldn't even talk to me. I said the same thing to the trader from Goldman Sachs. I said, Altos Research has all this real-time data on the housing market. We can see where the market is going to be months before the traditional channels. And the trader from Goldman Sachs said, that's interesting. Let me see a sample. If I like it, I'll buy it. Turns out Goldman Sachs became one of the very first institutional clients of Altos Research in 2007. By the January of 2008, all the signals in the Altos data, the price reductions and the price increases, the inventory changes, all the leading indicators had switched from being bullish to being quite bearish. And turns out the traders on that mortgage desk from Goldman Sachs got short the mortgage derivatives markets a full quarter before anybody else did, and it saved the bank. 6 months later, Lehman Brothers didn't even exist anymore. And so the lesson here is when we move from the hottest market ever to inevitably the market changes, the right data to be looking at, the right data to have your clients looking at is going to make all the difference. Going from a time from when everybody knows it's hot to, wait a minute, is it changing? Like, that's why we do what we do. So it's October, and we're looking at the fourth quarter now. We're going to look at what the market's saying right now, what all those leading indicators are telling us about the future, and is it any different from where the headlines are? So, welcome to the event today. Before I dive into any further, a little housekeeping. There will be a recording of the webinar, so all the registrants and attendees will get that emailed to you later today. So keep your eye on your email box for that. We have 2 people from Altos Research in the chat. So use the chat feature here today. When I share links, or you can ask questions, look in the chat, you can get the links, you can click through there to get those resources as I mentioned them during the webinar. That's Lael and Jeff from Altos Research there in the chat. I will dive through some of the data, the current data, the slides, and then we'll do a little bit of local market analysis, and then we'll wind up. So, agenda for today, the big questions that are on people's minds. What's going on? We've been such a wild market, so unusual. unseasonal? Which of the patterns are going back to their normal seasonal shape? We'll look at some of those today. There are leading indicators in the data right now that tell us for the rest of the fourth quarter and what we can start to expect for 2022. So I'll try to point those out today. We're at the end of the forbearance process, 18 months of mortgage forbearance for the pandemic, for people who are impacted financially by the pandemic. As that's changing, we're getting to the end. What can we see and what can we expect? Is a slowdown coming? Are we at that point like we were with the Goldman Sachs folks, where they were able to use the data to see the change before the rest of the market? We'll take a look at that today. And then, of course, as we're going through the data, we have hundreds of people on the call, but most of the crew here are realtors, agents, brokers, professionals in the space. And so I like to try to help us articulate, how do you talk to buyers and sellers about the market, about the data right now? So I'm going to try to point out some scripts, some ideas, some ways to communicate that as we go along. Okay, let's dive into the data. So the median home price in the US right now for a single family home, unsold, active on the market, $389,900. So 11% gain over last year. One of the interesting things about the annual gains is last fall was so unseasonably strong. Prices stayed elevated for so much longer that our year-over-year gains right now are, they're muted a little bit. Even we've had such a massive year of price gain, but it's still, 10, 11, 12, 13% by the end of the year. We can see in this chart here, the light colored line is the median price of the newly listed cohort each week. So this is one of the leading indicators that we point out for, like our friends at Goldman Sachs back in the day, but to see where the market is heading right now. And the way it works is this: each week, agents and sellers, the listing agents and the sellers, have to choose where to price the new listing, and they will take into account all of the other sales, all the foot traffic, all the open homes, all the competition. And in those cases, what we see is, we can see in this data the very first signs of any weakening. Like you see down the street, wow, all of a sudden there was no offers on that last home. We went from multiple offers to no offers. Now we know to price the next listing a little bit lower. So this light line adjusts down quickly in a cooling market. What we can see right now is that you can see it's stayed kind of elevated at this plateau level since June. Normally, you can look here in 2016, 2017, 2018. You can see how they drop off. That drops off in the third quarter, actually. And we didn't really have much of a drop off. That shows us demand is there. Pricing support is there because the sellers know that I can list at this point and I can get my price. And therefore, these are houses that are just getting listed now, and they will be sold in October, November, even December. So the transactions that will happen in the future are already visible in this leading indicator right here. It's one of the things that shows us that pricing strength is going to continue for several more months. One of the other leading indicators, if you watch Altos research data, one of my favorite leading indicators is the percentage of properties on the market with a price reduction that have taken a price reduction recently. Normally, about a third or 35% nationally. In some markets, it's higher. It's maybe 40% is normal. That means that you list, you try to get, you maybe need to take one price cut before it sells. Sometimes it's a strategic move. Sometimes it's an overzealous seller, whatever the reason is, but it's 35% take a price cut. When the market's hot, fewer than that take a cut because thought I was overpriced, but I got my price. So I never took a price cut. And what we can see here, each line on this chart is a year. So the year starts strong. February, March, April is when the best new listings come, when the buyer demand for the year is at its peak. And then if properties haven't sold by June, July, August, now you start taking a price cut as the summer ends. Price cuts peak in November, and then the market churns away and like they drop off the market and there's fewer new homes. So it resets to begin the year again. So you get this normal curve. Each year has this really normal curve. So recently, about this time of year, we'd have 37% taking a price cut. In some markets, it's probably, it's a 40 or 45 would be normal. In some of the hot California markets, for example, it might be more like 25% is normal. And so right now we're at 29%, way up from the frenzy in March, April, May. We were down at like 15%. So a third think they're overpriced, but we're getting all these offers, so nobody has to take a price cut. You can see last year had this crazy unseasonal curve to it. It never cooled. And so we are less frenzied than last year, but still plenty hot compared to normal. And I'm sure you feel that in your market. If you are interested in keeping your eye on whether the market changes, or your clients, your buyers and sellers are worried about market cooling, about bubble bursting, about whether they need to act quickly, this is a great number to keep an eye on. If this number, for example, keeps climbing into, say, December, January, that's going to tell us that demand has somehow fallen way off. I don't expect it to. I think we're going to see our normal curve here. It's going to end, we'll see, end the year about 28%. We'll have a nice, strong February. That's where the signals look right now. But as the Goldman Sachs lesson teaches us, what I try to do is I have a hypothesis about where the market will head. I can watch this number every week to know if the data is actually, if the market's changing, if I should update my hypothesis. If I was that mortgage trader at Goldman Sachs and I went from 2007 to buying the mortgage derivatives to 2008, and I need to sell them because these are cooling signals, update your hypothesis based on what the data is telling us. So the leading indicator here, price reductions, is definitely cooler than last year. It's not crazy. That's actually encouraging, because too crazy is not good for anybody, but still plenty warmer than most years at this time. Let's look at inventory. Supply has peaked for the year. We have 428,000 single-family homes active on the market. It's ticking down now each week for 3 weeks in a row. Looks like it'll be down again this week. What this is showing us, as we have very strong seasonal patterns in inventory. Very recently, we'd have 1 million or 1.2 million homes on the market at this point in the year. Each year that tends to get fewer and fewer as more Americans own investment properties. We've taken, gone from we've taken 7 million or 8 million homes out of the resale market and moved them into investor-owned rental properties in the last decade. And so you can see it each year, it gets fewer and fewer. And most of those investors are own 1 to 4 units, they're individual investors. And as mortgage rates are really cheap, I can buy the next home and I can afford 2 mortgages and keep the first one for an investment property. And more people do that. They come out of the resale stock, so our inventory shrinks each year. What's happened in the last year is that happened a big amount, and everybody's gobbling up everything in sight. And so we've actually shifted the whole cycle from around 1 million homes to around 400,000 homes. And it looks like at this point, we're going to be in this cycle for the next few years. That means next January, we'll probably start January with fewer homes in 2022 than with 2021. The one thing that would change this is if mortgage rates start to rise and rise appreciably. They're ticking up, and we'll take a look at that in a minute. But as of right now, it's really a new normal level. There's no signals that we're going to get back to 1 million homes on the market. And that has implications for your buyers. It has implications for your sellers and how you talk to your clients about the market, what to expect. It's going to be a tight market for several years at least. Here's another way to look at inventory. Each color here is a year, 2015, 2016, 2017, 2018. And above the line is when inventory grows in a given week, and below the line is when it's shrinking. And you can see at the beginning of the year, inventory grows. At the end of the year, inventory shrinks. What we're using this chart for is to keep our eye on the properties that are in forbearance. There's still a little over 1 million homes, 1.4 million or so homes that are in the mortgage forbearance process. The last 18 months did not pay their mortgage or were opting to maybe not pay their mortgage. They were in the program based on the financial hardship of the pandemic. This is the 18-month mark. And by the end of October, there's 400,000 of those that will come out of forbearance. And you either have to get current on your loan, you renegotiate your loan, or sell the property. The bearish case, and there's still a lot of folks who are thinking about the bearish case of the market here, is that there's 1 million, 1.4 million people that haven't been paying their mortgage. Now they have to. And if they can't, they have to sell their home. What we've noticed, what we've been able to measure so far is that very few of them are selling. They're almost all going into basically restarting their loan payments with the amount that they've saved or that they didn't pay tacked onto the end and just resuming their loan. That's what's happening for most people. And what's fascinating is that in the last year, the average American has gained $51,000 in their equity. And if you think about that, so even if you didn't pay your mortgage for the year, you didn't pay your $2,000 mortgage payment, say, you're tacking on $24,000 to the principal of your mortgage, you still gained equity without paying. It's like taking a home equity loan without doing any fees, or you just literally took that cash out. And you gained wealth in that time. So because of that, because Americans have more equity and the loan mods are working really well to put the transaction on the end, the principal on the end of the mortgage, almost nobody has to sell. But if we want to keep testing our hypothesis, we want to make sure that that's true. What this will show us is the very far right side of this chart is the light green. That's the rest of the year. And normally it'd be below the line, inventory shrinking. If we see properties at the end of October coming to market because they need to, we'll see these bump above the line. It will be very obvious to watch to say, aha, there's more inventory coming. We don't see it coming. It hasn't been coming, but this is how we're going to be able to see it. And you'll be able to stay tuned here, and we'll keep visiting and make sure. Really, it turns out that there's only about 20,000 of the homes that, based on the current trends, will probably sell in any kind of distress, meaning like, I got to sell this house. I'm never going to be able to make the mortgage payment. And it's 20,000, and it's not 20,000 right away. It's 20,000 over probably, the next year. And that's the max end. So it's really like a few homes here and there that will come to market, like will add to the inventory levels based on the forbearance. There's still a lot of folks who have a bearish view of the American consumer. And they have a bearish view of the housing market. They think we're in a bubble, like we've had strong price appreciation. So the talk of bubble is still very common. And a lot of folks will point to the forbearance program. There's a 1.4 million homes, 1 million mortgages, 1 million homeowners that have to resolve. And they point to that as an opportunity for the market to tank. There are three things to think about here. So we know that everybody has equity, record levels of equity, gained record levels of equity. Average American gained $51,000 worth of equity. And therefore, almost no one in America is short on their mortgage, owe more than the house is worth. So if there's nobody short, there will be no short sales. And if you're not upside down on your mortgage, and you can sell your house really quickly, there's very few people walking away from their mortgage and going into foreclosure either. So what it really tells us, and this is a chart from the mortgage bankers, but you can see each week, fewer and fewer people in the forbearance program. Last October, there was a big dip right here because everybody at the 6-month window resolved. So you're gonna see another big dip this month. And so the data right now shows us that almost nobody going into foreclosure. There's almost nobody selling their homes coming out of the forbearance process. That's what the data says as of right now. And on the demand side of that, so even if I do have to sell the home, I know that we know that demand is still remarkably high. And one of the ways we're measuring demand is with our immediate sales tracker. And the process is homes that are getting listed and then taking offers and going into contract within hours or days of listing. A lot of what's happening around the country is a lot of homes are being pre-marketed as coming soon. And so the day we list, now there's already offers ready to be written, already offers in hand, and then boom, we can close. So that is a trend that seems to be continuing. It's both a function of demand, but also how the homes are being marketed. It's a function of technology. So transactions are happening faster. So this week, 24,000 single-family homes went into contract immediately. It's a really big amount. I expected this to back off as we went into the fall. It hasn't really backed off at all yet. So I think this is really a view of the demand levels out there. One thing that's different now from 6 months ago is at the peak 6 months ago, we had the multiple offers scenario. The reports are 20 offers on a single property. And now it might be 4 or 5. So we can feel as participants in the market, weaker, lighter demand, slightly lower demand. But we still have 5 offers on a property. It's still selling immediately. And as a result, the demand is still there. So it's one of the ways we look at saying even if you feel like demand is weakening, or you have a hypothesis that the market is overheated and going to tank, this is one other place. One of the first things you'll see as demand weakens is there are fewer immediate sales. Homes have to stick around on the market significantly longer. And you'll see it right here in each week. I would expect this to drop significantly. You can see the big dips here are 4th of July and Labor Day. You'll see it again, as at the holidays, Thanksgiving and Christmas, those will drop significantly. Fewer people buying homes those weeks. So, and then we'll expect it to shrink before we start January again. We've talked about the percent of homes with price reductions and how that's a leading indicator for where transactions are going to happen in the future. The house is on the market now. If demand is not there, buyers aren't there, we do a price reduction so that we get an offer maybe in October so that it closes in November. Or it's on the market now, it does a price reduction in November, so it closes in December. So you can see the price changes are leading indicators for the transactions that will happen in the future. On the flip side of that are price increases. And typically price increases are a function of investor activity, flips and fix and flips and things like iBuyers who are buying at one lower price and putting them back on the market a little bit later at a higher price. This chart here shows us a couple things that we can see from this chart. We're currently at a 3.3% of the homes on the market are recently on the market at a lower price. So these are price increases. Normally, in normal, actually hot markets, as it has been for several years, 2.6, 2.7, 3%. Last year was nuts. And so what happened was, there were houses on the market in March. They pulled off the market in April for the beginning of the pandemic. Then all of a sudden they realized by October, they said, wow, there's buyers out here. I'm going to list higher than when I was on in March. And so they came back and were way up. And so there were significantly more price increases last fall. Then the other thing that happened was the winter, December, January, February, were unseasonably strong last year. There were way more buyers than usually buy in January. And so now a house comes off the market for Christmas and comes back on the market in February at a higher price because, oh my God, there's so many more. We hit this market at the end of March where we peaked the frenzy, and now it's starting to come back down into a more normal zone. So contrast this with inventory. Inventory is in a new normal. Price increases are getting back to their old normal seasonal patterns. April is usually the peak of price increases because you've got like a strong part of the year, and then there's fewer of those that happen later in the year. You can see the little seasonal curve of these each time. This year was so nuts and is now trying to come back to normal levels. You can see that in a lot of the hottest markets, places like Phoenix or those kind of markets. Dallas had really high investor activity. Phoenix is a real high investor activity, so you'll see a lot of price increase attempts in those, and you'll see that number come way back down from where it was earlier in the year. The leading indicator that is often most easy to use with your clients is the Altos Market Action Index. This is supply versus demand, and it turned into a speedometer. So when this number goes up, the market's getting hotter. There's less supply, there's higher buyer competition. As it ticks down, that means supply is increasing relative to the number of buyers. And so when you're working with a client, you take your Altos report and you say, I'm going to put this in your inbox every Monday. I want you to look at one number. Well, we have your house listed. We're in a strong seller's market now. It's 60. It's been remarkably high all year, obviously. Everybody knows that. Is it going to change? What if we try to overprice your house? How do we know when if the market is telling us we might need a price reduction? If the market action index declines while we have your house listed, that's the market giving us a signal. So that's the market saying us there are fewer buyers and there's greater seller competition. Especially if we get to 30. 30 is a balanced market here, and below 30 is actually buyer's opportunity. Very few markets in the country are in buyer's opportunity right now, but there are plenty of them that have been taking off this absolute peak. And you can see in the time series here, the chart at the top, that in June we had this peak record. We're at ultra sellers territory. Everybody knew it. Now we know that that we can see that demand is backing off a little bit, and often the question here is, the market is cooling. Should we worry? The analogy that I've heard I like the best here is, if you're driving your car at 100 miles an hour on the freeway, and you take your foot off the gas, you are definitely slowing, and you're still going really fast. They both can be true at the same time. The market can still be very hot and cooling at the same time, going very fast and slowing a little bit at the same time. And like our price reduction, our price increases number, this is backing off out of the crazy zone, and that's encouraging to me. You know, earlier in the year, the reports were the, you know, first-time buyers who just, there's nothing, and anybody who wasn't didn't have mounds of cash, was not able to get the house they wanted. They're starting to be able to get the house they want. And one of the things that's keeping demand elevated this fall is there was a whole bunch of people in the spring who couldn't, they simply got outbid and couldn't make it in. So they're doing their transactions now. So you can see that pattern over time. So keep your eye on the market action index. We'll see where it'll decline a little bit through the holidays and then reset and start for the beginning of the year. We're still in seller's market territory, still lots of opportunity there. On the market time, still in the record market time, you know, but it's that time of year we're slowing. So houses get listed now, you know, now we're past the start of school. All of a sudden, October turns into November and fewer buyers. So we'll see the market time ratchet up a little bit. We're still at 35 days for the median single family home, and which is for this time of year, it is still a record. You know, normally it's twice that. Normally this time of year, it's 70 days to sell a home. And you can see very normal seasonal patterns. What I expect here is that we will start 2022 will be faster than the last few years, but not quite as fast as the frenzy of April 2021. We'll be able to see it because we're going to have tight inventory and we're going to have plenty strong demand. We'll be able to see us. My guess is that we'll be by this time next year, we'll be in that 49-day range, not 70, not 2.5 months, but a month and a half as the time to expect next year. It'll be a little more normal, but in a different pattern than you know, earlier 5-6 years ago. And there are some things that will change that. In particular, it'll be mortgage rates, and I'll try to take a look at that in a second. And then one more number here, the percentage of homes on the market that have been relisted. The relist percent is one of those things that will help us catch a bear market. In that 2007 time, you could see homes in places like, I was watching at the time, it was very early with Altos research, but watching Silicon Valley. On the low end of Silicon Valley, homes would be on the market, they'd go into contract, and then the contract would fall through and they'd get relisted. And that was a very early signal that that the market was changing. All of a sudden, the relist percent went from 1.5%, 2% to 20% in San Jose. And it was a real telling signal, is a real leading indicator. What we know right now is that relist percent is not increasing. That means that the demand is there and the contracts are still happening. There's nobody walking away from offers. We will watch that. That will happen. Properties get pulled over the holidays and they'll get relisted in January. So you get a little January reset spike. That'll happen. But there's no signal of market bearishness, no bubble bursting, nothing in this data to be fearful of at this moment. When we talk about the data, I always want to make sure, especially when you're talking with clients at the local market, that we talk about the price range segment that your client is working in. This is, Altos does every zip code, city, state in the country into 4 price range segments. The high end of the market may be behaving very differently from the low end. And in this case, this is the national view. The high end of the US market is about $1 million. And what you can see here is the highest demand part of the price segment is right around $310,000. You can see this is a 3-bedroom, 2-bath home. And you can see that the days on market on the right-hand side of this, 28 days. a little bit higher price, takes a little bit longer to sell. The $1 million price is 2 months. These are all super low compared to normal, but you can see exactly where the demand is in the US. What's interesting is there are markets in the US where the high end is the highest demand and the low end are the 100-year-old junk that people don't want to buy. And so you can, when you're working with a buyer or seller, we say, here's what you're looking at right now. And nationally, we can see there's 19,000 of these that hit the market and 26,000 that went into contract. But in your zip code, it's like there's 4 in our price range. And you can see that there are 2 new ones. And so if you want to buy this house, we need to make an offer now. And by using that quartile, it's a powerful way to communicate that. And I actually used it with a contractor who was working on my home recently, and he was buying a home in San Jose, and he wanted to know if his realtor was lying to him. And that fear that consumers have. Like, my realtor is telling me I have to bid right now. Do I have to? And what we looked at was the price range quartile that he was in San Jose. And we looked at it's a 7 days on market in his price range. Say, look, these homes are gone in a week. Your realtor is not lying to you. Like, this is what has to happen. And it's a scary thing to have to make an offer on a home very quickly. And so it was really useful for him to see the data. And he went and made an offer on the home. I haven't talked to him. I don't know if he got it, but he made the offer. And that was a really powerful way to communicate. By the way, this kind of way to communicate with your clients is what we describe in the Altos book, the ebook, How to Use Market Data in Your Business. If you click on that link in the chat there, if you haven't read the ebook yet, go download it. It's really useful for that kind of script, that kind of positioning. How do I describe this? If you've ever found yourself in a conversation where they say, like, I don't believe you, or maybe you can feel the trust challenge, that's why we have the data, and this is how you talk about the data with your clients. So click through that, download that if you don't have it. I'd love to hear your thoughts on it, your scripts. If you've got I'd love to hear how agents, brokers are using the Altos data with their clients. If you want to share those with me, send me an email. I'd love to hear those. Let's do one more chart on the data, and then we'll do a few minutes on the local data, and then we'll wrap up. So, mortgage rates. What happened the last few weeks of mortgage rates? They finally ticked up above 3%. In January this year, rates climbed, and I expected at the time that they would keep climbing for the year. They have not. We are just above 3% right now. In mortgage rates, as they tick up, you can see refinance drop. That's less impactful for our topic here today. My suspicion is that 3% is not enough to put a damper on our demand, but 3.5. The long-term average of the last decade is 3.9. We've had 2 full years, 2.5 years under 3%. So if we get closer to 3%, that's going to feel expensive. It's closer to 4%. That's going to feel expensive. And so 2 things happen. One is that cools demand. I can afford less, or I shift to a cheaper property. But the other thing that happens is, I mentioned about how our inventory has been impacted over the last decade. As mortgage rates are super cheap, I can afford to keep my first home when I buy the second home. When I trade up or trade down, I keep the first one for investment property. When mortgage rates are 2.5, 2.7%, 2 mortgages is pretty easy to do. And now I have an income producing rental property. As the rate on the new property climbs, that means I am more likely to have to sell my first one to be able to afford the second one. I can't afford to. And so one of the impacts is that we will have more resale supply come to market. So one of the things, maybe the main thing that would get us out of this new low range of inventory is rising interest rates. And it's probably a couple of years of rising interest rates before we see a notable change. But, and what's unclear is how much, like, is it 3.5%? Do they have to get over 3.9? We know that in 2018, when rates, you can see the peak here in 2018, from like April to December of that year. You could definitely see, we can see a bunch of the indicators, inventory climbed, price reductions climbed, like all of the things that the leading indicators that we've been talking about today, they adjusted because demand cooled and supply increased as rates climbed towards 5% at that time. Now we've been ultra low, we've been down for 3 years since then. So what is that, what feels expensive? We don't know. But that's what we got to keep our eye on, and see how quickly the numbers adjust. Okay, I'm going to do a little bit of the local market here, and I just have a few pulled up because they've come up in conversation this week, and they so I want to share. I was talking with someone in Boise. And Boise was one of the really hot markets this year. And Boise, interestingly, has cooled in several significant ways. We've been talking about the percentage of properties with price reductions. In Boise, normally, we can see 40% to 40 is this 30 to 40% range is normal, a little bit higher than the rest of the country, for various reasons. A lot of times it's easier to build. There's reasons like that, investor properties. And then last year, price reductions just plummeted down to 8% this spring. That's because everything was selling, a ton of inbound immigration from California. Those are really the peak. And so we were seeing massive price increases week over week. And what's happened is in the last few months, price reductions are getting back to normal in Boise. Now, not cold, right? If we look at the market action index, we're still in a strong seller's market. This is not a cold market, but it is saying that you can't be too crazy. Buyers will pay attention and they will walk away from ridiculously overpriced homes. You have to price accordingly. You have to price properly. We can see down in the market segments in Boise, the $1 million top end, the 400,000 is, you can see that the low end in Boise is like where the fastest time is. They've all had massive price appreciation this year, but we can still see, like I said, still moving very quickly, but really interesting that we're moving back into more normal zone on price reductions for Boise as inventory has climbed. So then you compare to Charlotte. Charlotte is actually very similar in the price ranges, similar kind of market. Charlotte has, in the properties with price decrease, similar price range, 45–40% is normal for Charlotte. Last year, we cratered down here and not quite as hot as Boise. And what's happened is Charlotte's cooling, but not cooling back to normal. Charlotte's cooling into this significantly hotter market still. So Charlotte's at 29% rather than 45–47%. The immigration inbound for Charlotte's much more East Coast, like a New York immigration. For Boise, it's a California powered thing. And here's one of the things that's interesting here. At Charlotte, the high end of the market, the $1 million range, is obviously the slowest part. Where in Boise, it was still 28 days. Like it was a much easier purchase for somebody coming out of LA buying in Boise at $1 million is a faster transaction than is happening in Charlotte at that time. But it's still very powerful to like, here's your price range. Let's look at your price range. It doesn't matter, anywhere under $500,000 is still going in a couple weeks. So that's how we look at Charlotte. Charlotte's still in this super strong seller's market. I had a conversation with a friend in Alameda, California this week. And he asked me this, said, I have a house in Alameda and I'm trying to decide if it's worth my investment to add a second story and expand the square footage. So how did I look at this with him? What we looked at was price per square foot. So very easy I changed this guy to price per square foot. And I'm just going to look at the trend line here. And right now, $710 per square foot in Alameda. That is, and so if he can build at less than 700 a square foot, and he thinks he can do it at maybe 450, then that immediately adds equity, adds value to his home. It immediately adds wealth. So in one sense, like the very first case, like here's how you know this is a good investment property. Even if you were buying it and thinking to expand, or he already owns it and is thinking to expand, it's a great way to take a look. Here's the other way I did it, is in the market segments with him. His house is right here, like now it's a 1,500 square foot house. So he's right in this $1 million range. It's a nice property, so it's probably $1.2 million. And what's interesting is that it's a 2-bedroom, 2-bath. So that's the characteristics down here in the second quartile, but he's on a 5,500 square foot lot. And what that's up here, only the home. So Alameda is old urban homes, right by Oakland and San Francisco. So what this says is that if he builds and he adds 500 or 700 square feet, and he does so, adds a bedroom and a bath, and he goes from a 2.2 to a 3.3, he has the lot size. He can definitely price it here in the $1.8 million, $1.9 million, $2 million range. And so he can very quickly move from maybe down here in the market to up here in this segment of the market. And it's pretty reliable to get a very quick return on investment. Here's the other thing. In Alameda, the high end of the market is where the demand is. So like that looks like a very reliable bet to do that investment. And that's what that's what the data is telling us. And especially if you have buyers who are buying a first home and maybe thinking that in the future they will expand and will it be a good investment opportunity, that's a really excellent way to take a look. And then the other one I want to check in on is Austin, Texas, before the end of the call today. Austin is has been one of the crazy hot markets this year. And in particular, because inventory was so vastly lower as everything was getting gobbled up, so many inbound purchases. And so here's the inventory chart for Austin. Austin's still in the strong sellers market, but definitely ticking down. If we look at our inventory numbers here, I'll look at the trend line, several thousand single family homes usually on the market. Last year was 1,300, and then we were down here at 300 400 earlier this year. We've now climbed back up to a slightly more reasonable number, slightly less furious happening in Austin, more rounded. So demand across all the price points, not significantly slower at the high end, because this is also, again, inbound California purchases. So $1.5 million is still a bargain. There's still a lot of that happening in Austin, but it's a fascinating watch as inventory has definitely climbed to a more reasonable, slightly more reasonable level. In the price decreases, this is more on the way that Boise's acted. So if you're pricing way, let's get the suckers, the suckers still, take they know. And so then you have to take your price cuts. And I can switch this guy here to price reductions here, and we can watch what's happening with the price reductions so Austin is normally in this 35 to 50% range. Last year was lower. We were down 6% at the peak of the frenzy. And now we're getting back into normal. So again, inventory is shifted lower, but the price model, like people still know exactly what they're going to pay for, and they're going to react to overpriced properties. And those are the ones that are going to sit around. So it's a message to sellers who think they can milk the market. If you think it's overpriced, like it's a really good opportunity to point that out, the price reductions, and say 40% of the homes in Austin, they've taken a price cut. So let's not be dumb here. Let's do this properly. Okay, that is the whirlwind tour of the market, and I'm going to stop the share there. Usually I get to this point of the conversation, and people ask me, Mike, can we look at my local market? And the answer is yes, we can look at the local market. We can look at everyone local market. The way to do that is to go to altosresearch.com and book a demo with the team. We'll look at your local market. We will talk about how you could talk about the market. We can look at your quartiles, the price reductions, all of those leading indicators, so that you can be best positioned for your conversation with your clients. Okay. Thank you so much. That's all that we have the time for today. We'll do, as always, join the YouTube channel, subscribe to the YouTube channel so that you get our videos each week, and we'll stay on top of the market together, and we'll do another webinar in a month or so. Thank you so much.